Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Only because it's really important. And on the phone we have Gary. Gary, welcome to Talking Real Money.
Hey, Gary, how can we help you?
Well, I got a problem. My daughter may be changing jobs, and I don't have a lot of details, but the company she's going with has their 401k with Ed Jones.
Don, you went to school with Ed, right? So maybe you can talk about this.
Yeah, Ed and I graduated together.
Yeah.
No, I don't know.
That's a bad
Well,
joke.
here's the dilemma. I don't have any details on it. She's just in the discussion stages. I do know that they match. She thinks it's 100% dollar for dollar, but I don't know up to what percentage.
Mm-hmm.
She does not know what funds or anything like that, but everything I have tried to find on the Internet, I can't find any details other than they look like they use mostly loaded funds. They have front-end load commissions. There's back-end fees. I can't find any definitive to see what funds they offer or anything. She is hopefully going to find out something more in the next week or so. I'm just looking for, what do I look for? Is this new fiduciary rule that Trump
delayed?
Postponed? Is that? Are
It's
they
bad
honoring
news.
that, or
No,
what
they're
is
not.
going on?
They're not. Trust me, they're not honoring that
Until they have to.
Until they have
Yeah.
to. Here's my guess. I'm going to guess for you, and then I'm going to give you an idea for down the road when she knows more. Just from what I know about Edward Jones, they tend to emphasize the American Funds Group in their retirement plans.
Which wouldn't be horrible for actively managed funds. Not horrible.
Right. Let me give you the good news. There is some good news about this. The American Funds Group, if they use the American Funds Group has a very honorable system that is called breakpointing. If you exceed a certain amount of money, the commission declines and then declines
come
and then
on, now I'm
declines
going to stop you there.
again.
I would hope in a retirement plan you would not be paying commissions. Now, you might
Well,
be
it
paying
depends on how big it is.
Yeah, gosh, that would be
no.
horrible. Horrible.
No, odds are you're paying a commission. But that's one of the good news points. The other good news point is if they are matching dollar for dollar, she should at least take advantage of that because 100% return on your money eats up a whole lot of bad commissions and lousy funds.
But you do that up to the match, and then she could do, for example, a Roth IRA, put the money at Vanguard to give you more exposure.
She already has that.
Okay, but
I'm a Roth.
Good.
And I'm a Vanguard fan.
There you
Most
go.
of my money is at Vanguard.
Terrific.
A lot of her money is at Vanguard, including the retirement plan that she's currently in with her current employer. She has a kind of like a cash balance plan, and she has it in some Vanguard funds.
Okay, good.
So,
here's the other thing, and here's the action item for you. This is what you will do she will do once she knows what the plan details are. Have her go to 401411.com.
Mm-hmm.
Have her send the plan in. We will analyze the plan and set up 3 portfolios, one conservative, one moderate, one aggressive, and then she can at least try to pick better funds out of those selections so that she can take advantage of that matching contribution. So that's what she should do. Thank you so much for the call. The number is 877-397-5666, and yeah, Tim, you're up. Welcome to the show.
Tim, this is Tom. How can we help you?
Tim, Tom, Don?
Yeah,
okay.
Easy.
All right, thanks for doing the show. I first came across these, I don't know what the industry name is, but they're funds that are like based on the year you retire.
Target date funds.
What are they called?
Target date funds.
Target date fund. In other words, it refers to the year that you will retire.
Yeah, so
Okay.
They're using them in my thrift savings plan. That's military or government employees. But now also in my commercial company that I work for, they wanted to give me this option, and I just kind of, what do you think of those target date plans?
Let's talk about those. First of all, in the TSP, we would not recommend those because the TSP has other very fine mutual funds, and if you build an asset allocation,
the life cycle funds there are okay.
They're not. Here's the trade-off. I guess that's what it is at the end of the day. If you don't want to do anything and you just want to put it all in a fund and have somebody else, here's what a target date fund does, or life cycle fund. It adjusts the risk in the fund to your age. It's saying you're getting older, you should be taking less risk. It doesn't know anything about you, by the way, and it doesn't know what your plans are, but it just says put the money in there, we manage it. And here's the other part that I dislike slightly. It ends up most of the money is invested in large U.S. companies. Nothing against those. By the way, so those have been a fine place to invest this year. Companies like Amazon and Microsoft, some big companies, made a lot of money. But over time, you don't have as much exposure to small and to value and some of the things that we'd like you to do. So if you're just saying, I just want to check the box and get on with it, it's okay. It wouldn't be our first choice generally.
Yeah, although the life cycle funds, I got to give the government credit for this. Because those life cycle funds use the G, the F, the C, the S, and the I funds. They are pretty well balanced, given a very typical age-based scenario. For example, in the 2050 fund, which is a 30-year retirement approximately, you are about 80%, actually a little over, about 83% in equities.
Okay, so your stock to bond ratio. So here's the other
part,
part, Tim,
80-20.
that you need to consider. In that portfolio, along the way somewhere, you're likely to lose 35 or 40% of your money. Are you okay with that?
They do put 15% in small. So
okay, so you got some. I mean, are you okay with seeing the value of your portfolio go down by that amount? That's the question you have to answer.
And let me give you an easy way to answer that for yourself, Tim. You can determine what's your risk tolerance, at least get a better idea what it is, and you can do it absolutely free. We don't even call you. Just go to TalkingRealMoney.com and take the risk quiz.
No, that's at Vestry.
It's also at Talking Real
Oh,
Money,
I didn't know that. Where is it? Yeah. It's up on the homepage there? Right on the homepage. We have a lot of people taking that risk survey lately. It's been something. Because then you get a little bit of feel about who you are with your money and how much you understand about markets, that kind of thing. So it is helpful.
Yeah, go take that, and then you get a better idea. But the life cycle funds are fine for somebody who just wants to do it, set it and forget it.
Yep.
Otherwise, we like the idea of a better balance, a more scientifically based balance, which is overweighting small, value, overweighting international. But it's not just your age, it's your inclination, it's your risk tolerance. That's why taking that risk quiz is so darned important. 877-397-5666 is our telephone number, and we absolutely positively want to help you retire better and answer those big retirement questions, so call with those right now.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
For your real life and real future, Tom and Don are talking real money.
The most important conversation going on the radio. There are talk shows, and then there's a talk show that can really improve your life. This is in the latter category? Yeah, this is in the latter
Checking
category.
the box, yes.
Really improve your life talk show. And Paula, it's now your turn. Welcome to the show.
Hi, how are you doing?
We're doing great.
Thanks.
Yeah, thank you for asking.
Well, I have a question for you about retirement and divesting from different investments and the tax question. You know, I think I've done a pretty good job of investing in a lot of different areas. And I'm also military retired, so I have my pension and pretty close to drawing Social Security, but I'm worried about when I try to get out of a mutual fund or a stock, or how to avoid paying so much taxes.
Well, so is the money in a non-qualified account? In other words, is it not in an individual retirement account or retirement savings plan?
I have traditional IRAs, both in money market CDs and in mutual funds. So I would guess that they are both qualified.
Yeah. So, I mean, and how old are you?
I'm getting ready to turn 59.
Okay. So here's one thing to consider. If you needed income, for example, once you reach 59 and a half and you take the money out of a qualified plan or an IRA or, a retirement type plan, you're going to pay you're going to pay income tax on the money you took out. And there's no way around that. But at least wait till 59 and a half, because before that you're going to pay the income tax plus a 10% penalty. We don't want you to do that. Conversely, if the money is in just a regular brokerage type of account, taxable account, the only taxation you pay there when you take money out is the capital gain between what you paid for a security and what you sold it for.
And that would be taxed at a much lower rate.
Okay, so it's going to be a matter of timing how I start taking money out to use, because
yes, ma'am.
So far I've just been retiring for the future and I haven't really been using any of the money, for that big retirement date. But, I need to start having some fun, don't I?
Well, yeah, you do. And here's the other thing. I mean, in my way of looking at this, you might want to get the help of a professional, because if you do have a question about where the money should come from, it would be tragic for you if you have any longevity in your family to take Social Security, for example, before your full retirement age, because you get, as you may know, an 8% a year raise every year you wait. So there's no reason to start hauling the money out of that. There's none of your investments, we'll talk about this later, that you would expect to make 8% a year on.
Just like you would hire a lawyer to look over your wills and trusts, sometimes it's a good idea to get somebody who's a fiduciary, who is not a salesman at a brokerage firm, to look over your plan and give you some idea of how you should start withdrawing money from it. But there are ways to do it to minimize the taxes, and one of the biggest ones is don't take anything out before 59 and a half.
Yeah, that's an easy
absolutely
one.
Never do that. Okay.
All right. Well, thanks for your help today, guys.
Thank you.
You are very welcome.
Thank you for your service.
Thanks for calling.
We appreciate.
And you're going to be at our classes, our brand new class,
I'm gonna show
coming up in May.
Yeah,
you're going to but you're going to be talking about that, how to create that income stream, which assets you should use first and second and third, and why it's so important to wait on Social Security, and how you can create a portfolio that's more designed toward income creation than and maintaining your assets.
It's a lot different than building the money. Number one, number two, and people generally they don't think this through. Just take some money out of there. The taxation of all this is incredibly important, Don. It really is.
That's why he sticks me with the hard part of the presentation, which is building. I'm the construction crew, and he's the guy just like, I get to spin the dough now.
How about that?
Yeah, he's the CEO. Can you tell? Bye.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
And it's really easy to get the real story about your real future on this really great program today about the really big questions.
You're reeling them in. Good job.
Retirement.
Yeah.
Thank you,
Okay.
Mr. Pun. Tom is Mr. Pun.
Okay. I'll take that.
He's the fun pun guy.
Oh, I'll take the fun part, too.
The funny punny guy.
Okay. I'll take all those. Sure. Why not?
All right.
All right.
Oh, wait. I'm on the wrong screen. There we go.
And apparently,
All right, now we're good.
you did something in Texas recently because a lot of people are calling from Texas.
It's
Another
that
call from
podcast
Texas.
thing.
Yeah.
It's the podcast.
So
The podcast, and you know what's funny is we've redone the podcast in the past couple of weeks. The podcast.
I got to be
has
honest. It sounds really good.
I've got a great editor now.
Yeah.
The podcast has been squished down from about an hour and a half to an hour. Mm-hmm. It's like an hour and 6 minutes, and the popularity on iTunes. They have these little popularity charts. The popularity on iTunes now is shot right up.
Really?
It's gone up like crazy. Now that we've got the shorter one,
We have been, and I got to say this, okay? That's gone up. And I don't know what the deal is, but I've done this several times, but recently it's been crazy. The last two posts I've done on LinkedIn, that's as social media as I get. I don't do
that is
the other
your
face
social
thing.
media.
But the previous post, I got like 3,700 views, and then I just did one about my son's, scholarship thing.
Scholarship, yeah.
Like 2,500 views. Who are these people? I don't know. So I know that's not Earth, but for me, it's a big deal.
Oh, and here's the deal. If for those of you listening to the podcast, I mentioned this in the more recent podcast. I'm doing a deal for the podcast audience. If you go into iTunes and you review the podcast, see, the reviewing it gets it kicked up in the ranking.
Yeah, of course.
And I'm not telling you to review it good or bad. Just review it. Review it. Make sure the review's not like good show. No, it's got to go over a line, 2 lines. If you review it and you send me a note to don@talkingrealmoney.com. Send me a note. I'll go look. And if you reviewed it, then I will send you a code for a free year of Real Investing Journal.
Wow.
A free year of
A
Real
year?
Investing Journal.
It's a magazine. It's a nice magazine.
Retail
It's
value
pretty.
$15.
Okay.
Yeah, it's like free money.
There you go.
877-397-5666 is our number. Francisco, welcome to the show.
Thank you, guys. Question. I've recently, first of all, I've got a 401k with my employer and fully taken advantage of the matching that they offer. And now recently, as a result of listening to your show and your guidance, I've opened a traditional IRA account. So I want to thank you for that, for giving me some of the education that I needed. Question that I have for you is, on a traditional, the funds come pre-tax. So like the 401k, how can I set it up so that my money that's going into the IRA is being taken out before taxes?
You can't. No, but
You
you're going
can't,
to
but you
you're
get
going
a
to take a
deduction.
deduction. Right. So when you do your taxes, you're going to simply say I took this much, I paid this much to an IRA.
I have an idea, though,
Yeah.
that's the next best thing to doing that, Francisco. Here's the deal. Just if you are contributing $5,000, for example, to an IRA, and you know that is going to amount to a net change of $1,500, for example, in your taxes,
Yep.
go in and change your withholding.
Yeah. Just save less.
Oh,
Have less money
pardon
withheld.
Me, give
Have
less to the government.
Give less
Sure.
to the government in every paycheck, to the tune of $1,500 or so. And then when you take that deduction, it's just like having it taken out pre-tax. It's the next best thing.
so you're saying get less money on my paychecks every month?
No, you're going to
get more money on your
Yeah.
paycheck.
You're going to give
Go
less
in.
to the government. You're going, in
Yeah,
other words,
give less to the government.
You're going to have more exemption, whatever that I was,
Well,
You just add an
I think
exemption or
yeah.
two.
or more than that. But
Yeah.
yeah.
Gotcha. Yeah, I think I did that. I purchased a home last year, and so when I completed my taxes this year, I took the initiative last year and increased my exemptions to 6.
Good. Good.
And so when I did that, that did exactly what you're explaining. This year, my tax bill, and because I opened up my IRA, my tax bill was reduced. The thing that I didn't notice was that it seemed like the deduction that I got was sort of. I guess I was expecting more. Because
Here's what you're thinking, Francisco, and I as one who does taxes regularly,
You still do your own taxes?
I do my own taxes.
That is so un-American.
Hey, it's actually really good to see it.
No, I agree.
It
I
is
agree.
kind of disappointing to take a deduction because you're like putting $5,000 into something and you're only getting $1,000 or $1,500 in reduced taxes. It's not a tax credit; it's a deduction. So you're not going to see a huge change, but it is a change. It is a reduction. It is something. And if you're paying if you're getting a refund and you're doing an IRA, then you need to step it up one more exemption or so.
Tom and Don are talking real money.
Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
A new survey is out of wealthy advisors and the investors, wealthy investors. The investors believe that after inflation, which you can figure at about 3%.
About 2 to 3.
Okay. After inflation, they are going to make 8.5% a year.
What?
After inflation, so your rate of return is about 11.5, or say 11.
Okay.
Now,
11.5.
every
11.5.
single, you can go look at these on your own. I think Morningstar now has, you can go look at the surveys there. You can go look at Dalbar Research's work, how much investors really make, because I think we have this in our class, right?
Yeah.
Mutual fund
well,
investors.
something akin to it, yeah.
Yeah, I mean, they make about 5% before inflation.
It depends on Morningstar says more.
Okay.
Morningstar says
Well,
about
okay.
6.5.
Oh, pardon me, but then then there's that inflation thing that takes out the 3. So you are very, 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 very. We don't have enough time for all the varies. Unlikely to make anywhere near that amount of money.
Now, I don't know if this is coincidental or not, but if you take that 8.5% pre-inflation number and you add an inflation rate of 3% to that to come up with your 11.5%, you're awfully darn close to the Dave Ramsey delusional return number.
No, is that where we're going back to again?
Dave Ramsey on his show all the time says how much. He said you will get 12% per year from a stock portfolio.
I'd love to know what portfolio.
That's the delusion.
Yeah, there's no looking back that investors made that. There are portfolios that made that, sure, but we don't know anyone who invested that way, rebalanced it, and made that kind of money. I don't know anybody. I'll put it that way. And I think if you're honest with yourself and you really sit down and look at history and consider your asset allocation, if you're in a portfolio that is mostly in stocks, I think a more reasonable expectation would be 7 or 8% a year.
I think I see where they get this, though. I honestly do, and I'm not talking about the Dave Ramsey delusion. If you go back, and this is how you can play games with numbers, if you go back exactly 40 years from now, and if you went back and you invested in a total stock market portfolio.
40 years, so that puts us somewhere
1977.
In the 70s, late 70s. Okay.
Yeah. You would have made about 13.5% per year.
And is that overweighted to small in value, or is that mainly
large?
That's
a globally diversified portfolio.
More than I would have thought.
Now, if you went to the S&P 500, you would have, over that same 40-year period, made about 11.5.
There you go.
But that's being very selective.
That's before your expenses. That's before you panicked and did something in 2001 and 2008 and 87.
Right. And if you take it to a period that is a little more recent, over the past 20 years, you're down to about 7.5%. And remember, the part of the return and that wasn't a before inflation, by the way. That 11.5% return going back 40 years, several years of that, we had double-digit inflation.
Yeah, I mean, you go back to the early 80s, it was quite high.
You weren't beating inflation.
No.
And so your after-inflation return, the more likely number based on past performance of the stock market is somewhere around a 5 to 6%
Yeah, I think that's
return before
inflation.
inflation.
If you got lucky and made 7 to 8 and you start early and you save for a long time, you're probably okay.
Well, yeah, because with 7 or 8 with inflation thrown in, that's a 10 or 11% return.
Yeah.
And you would have done incredibly well because if you put $100,000 away back in 77 in the S&P 500 with that 11.5% return, your $100,000 today, 40 years, through all the turmoil in that period, about $7.5 million before taxes.
You'd be okay.
Pretty much,
But if again, when I sat down with people and they asked me, I said, before inflation, I think a real rate of return is closer to about 6 or 7. That's my take.
Really?
Yeah.
After inflation or before?
Well, I think you could expect to make in the long haul in equities 8 to 10% minus inflation.
Yeah. Okay. All right.
That's probably more realistic.
And it's not guaranteed by any means.
No, and then you've got to and here's the other reason to be cheap. When you start paying others 2%, 2.5%, I mean your return's getting down close to inflation.
I meant to. I got to find this firm. I was looking at one of the brokerage firms announced they were going to go all fiduciary, and I don't remember which one it was. It wasn't Merrill. It was somebody else, and I went and looked up their
Well,
their
Merrill's is
ADV.
like 2, I think, or something.
I went up, well, Merrill is 2.25.
Good Lord.
I went and looked up these guys' ADV, and it's 2. It's 2% again.
I'm glad you're a fiduciary.
That's a lot of money.
Yeah, it is.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
Reality radio for a really great future. We're talking real money.
We are indeed, because this real money stuff we talk about, the fuel for your existence. This gets you going. You know, it's okay you can have enough money to just get by, or you can have enough money to really thrive. And we really pick the latter. We're all for that. For example, today's topic is retirement.
Yes.
The big retirement question. Well, you can go into retirement and probably survive on Social Security.
Many people do.
Or you can choose to thrive when that day comes when you can't work, or can't work as much anyway. And that's what we want to help you do, is thrive.
And that's a great question. So there are people, among people listening and among people I met with recently, that are in their early 60s. And they had a divorce, or they lost a job, or whatever it is. And this question for you, Don. And they're like, well, should I...
had a divorce. I know. I admit it. I'm sorry.
So they're saying...
not in my 60s.
Should I even bother to put money in the retirement plan if I'm working for another 6 or 7 years, or just forget it?
Never forget it. You can always put it away.
Well, in this case, because there's a match, I mean, there's free money, number one.
Free money,
Number two is, you should be saving. Sure, why not?
Well, because even if it's for another 6 or 7 years,
Correct.
You're not going to pull it all out day one.
Exactly.
It's going to continue to grow some. You'll take some income off of it, maybe, and some of it will continue to grow for you to sustain you on into the farther future.
Exactly.
No, absolutely.
And some of them, by the way, were like, yep, I'm 64, I'm getting going, it's good, I'm making it happen. And other, I'll just get by on Social Security. So it goes.
That's just not really good for your future. Tim, welcome to Talking Real Money.
Hey, hello.
Tim.
Yes, how you doing?
Yeah, this is him. How you doing?
We are well, sir. How can we help you today?
Hey, listen, I got a question.
Yep.
Here it is. Got a friend who's a financial planner. Last insurance broker. So I've been talking to him about. All right, I know. That's what I'm calling you.
I know. It
You know
was
where I'm
funny.
going.
You threw the slash in there. I liked
Yeah.
that. That was good. Go ahead. Tim.
Whisper that part.
Well, that's what he is.
Mm-hmm.
He's an insurance broker. He's been talking to me about the pros and cons of an annuity versus mutual fund. So I got his penny on it. Yep. Annuity versus a mutual fund. I want to hear yours.
Well, what kind of annuity?
Can I guess?
Yeah.
I want to guess.
Don
I want to guess. It's more fun to guess.
Okay.
Tim, I betcha
Yes.
he talked about an equity indexed annuity or a fixed indexed annuity or something like that, right?
Right.
I knew
You are such a mind reader. You're just incredible. You are.
All right. Here's the deal.
But
now,
he also
I guarantee
talked about a
variable annuity.
Well, yeah, okay.
double premium annuity.
Okay, here's the deal. I guarantee you that he said these doggone annuities are a whole lot better than mutual funds, right?
To some degree. He was favorable for the double premium variable annuity.
Well, let me explain
I only
why
go
he
with a
likes
triple
them.
premium myself, but that's just me. No, I'm
Go
kidding.
quadruple.
Come on.
He loves them. He loves them because of the commission. The commissions on these products range. The commission paid to the agent / advisor in quotes. The commission runs from 6 to 8% typically.
Just saw one at 8 the other day. Yeah, it's incredible.
And that's on every dollar you put in, whenever you put it in. The other thing, let's just talk about a variable annuity first. A variable annuity has lots of extra expenses that go to pay for the tax deferral. You have to have insurance attached to the investment vehicle to make it tax deferred. And for that, there are extra fees, and there are extra fees for all the other gadgets and gimmickry associated. And what those extra fees do is they detract from the return of the underlying investment. Imagine for a second, if you will, the same investment portfolio. It's in one case, it's in a mutual fund. In the other case, it's with an insurance company. In the mutual fund, it's exact same investment. In both cases, it makes 10%.
S&P 500, for sake of argument.
In the mutual fund, let's say you pay 0.5% in fees and expenses, which is high. You're going to have 9.5% left. In the annuity, not even assuming any commission, their fees and expenses will probably run about 3% per year, leaving you with 7%. The fact is, and this is a fact, insurance-based products pay less than the same kind of investment done in a low-fee mutual fund, and I can say that without equivocation. Absolutely.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
I just want to start by saying I get a bad rap. I have a bad reputation when it comes to annuities. Don McDonald hates annuities. No, Don McDonald doesn't hate all annuities. Don McDonald just hates the annuities that almost all of you idiots out there are selling. And I don't feel bad calling you idiots, because if you can sell those things to people with a straight face and not feel bad, then you're just not the nicest person.
Number one, there is that I know of, not one reason to ever take your IRA, your 401k, and roll that into an annuity.
And let me add to that. There is no reason to invest in a 401k or a 403b in an annuity. And by the way, you poor souls, in the teaching and the healthcare professions, you are the most ripped off investors on the planet, because your retirement program, the 403b plan, has been usurped by the evil people at the insurance companies, at the VALICs. And by the way, your teachers union even has a terrible annuity that they will put in your 403b. You should fire your union for that. Just
never.
Say you done.
Never. I don't think you should ever own. There's no reason that I know of, again, an equity index annuity ever.
Equity index annuities are the most confusing, convoluted, complicated, built from whole cloth, stupid product ever invented, and they were invented by the insurance industry for the express purpose of of selling you a bill of goods, selling you a big lie. You can have the returns of the stock market with none of the risk. And I challenge anyone in that industry to come on the air and defend that lie.
The lines are now full. We'll get to them in a minute here.
I want them to call and defend the lie because they lie with impunity. And you know what? They can't defend it because they know it's a lie. See, I don't hate all annuities. I think that there can be a case made for the certain income that an immediate annuity gives to someone who is in a retirement situation or a disability situation. Absolutely.
And we just talked about the one last weekend where in the state of Washington, they have an annuity that has a COLA on it. You give them the money, they pay you back with a little bit of interest. You get inflation
there's a high
protection.
Degree of security there.
Yeah, you're going to, so you don't have to worry about that part of your portfolio.
But you see, that's what annuities were originally intended to be.
Yep.
The insurance industry, because they're not sexy and they don't make them a lot of money, the insurance industry felt compelled to start creating sexy investment-like products. Now, a funny thing about variable annuities is that those are regulated like securities. These equity-indexed annuities, despite the fact that they look like an investment and quack like an investment.
I was waiting for that.
They don't. They waddle like an investment. They poop like an investment. They just smell like an investment. Even though they have all of those characteristics, the insurance lobby managed to spend tens of millions of dollars convincing Congress that they should not be regulated as securities, that they should be regulated at the state level.
The same friends,
insurance commissioner.
The same friends of yours that are going to probably kick the fiduciary standard further down the road.
Oh, because it's bad for the little guy.
Yeah, you can't get any advice.
It's so bad for the little guy to do right by him because if we don't allow the little guy to mess up, then there's not a lot of money for the big guys.
Yeah.
Do I sound a little liberal? It's no wonder I can't be a Republican anymore. I gave up the Republican Party because
we're
of
getting
this
your real
stupidity.
Stripes today.
I'm telling you.
And we're on the same page here. Completely.
They've decided that the little people need to be stomped on. I'm tired of that. The insurance industry stomps on you, at least the investment insurance industry. They stomp on you. The equity indexed annuity business it should be, in my opinion, shut down, or there should be a big disclaimer on the front page that says, guess what? No matter what the idiot said at the steak dinner, you're not likely to make more than about 3 or 4% per year. And you're going to pay him a big fat commission. You okay with that? Yes, no, sign it.
Let me think. Would that be harmful to the future of that industry? Don't bother with page 1. Skip right down to your signature on page 7. Yeah, got it.
Well, and then I know I was being a little tongue-in-cheek on that, but the reality is it should be that simple.
Yeah.
It should be when you sit down with someone to discuss investing for your retirement or whatever, there should be a very simple one-page document that says, here's how much you're paying, and here's how much this has made in the past, and we're a fiduciary, yes or no, period. That's it. Done, 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 done.
And what you said a couple minutes ago before you really got ramped up about annuities, because they take in so much now, it's really confusing. But an annuity, what it should be, is money you saved. You're transferring the risk in a way to somebody else that's paying you back at some rate over the rest of your life. That's what an annuity originally was.
Well, let me give you the dictionary definition of annuity. A fixed sum of money paid to someone each year, typically for the rest of their life, or a form of insurance or investment entitling the investor to a series of annual sums. It is not anywhere described as an investment vehicle. It's a form of insurance that gives you a lifelong income. That's the whole point of an annuity, and they've been... there are words I want to use that I just can't use on the radio.
You want to? I can see it right there. All right. So we've worked our way through that.
All right. But again, let's go back to the big picture, the big question around retirement. This is another one of those big questions. Where should I put my money for retirement? And we told you where not to. It should never be in an annuity. Now, when we come back, we'll talk a little bit about where you should put that money
for retirement.
The real investments that should be there. There's always hope.
All right.
Spring's eternal in the spring.
I feel so much
Waxing
better now.
poetic.
Thank you. Yeah.
Tom and Don are talking real money.
Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
For your real life and real future, Tom and Don are talking real money.
Annuity, from the Latin annuitas, meaning yearly. That's it. It just means yearly.
Get your money.
That's what it just pays you back what you put in. You don't build wealth in an annuity, period. That's probably the best way to say it.
Actually, that's a good way to put it.
You don't build wealth in an annuity. You build the agent's wealth, but not yours. Where do you build wealth for an annuity? How should one build wealth for an annuity? It's a softball.
Oh, that's thrown to me. I thought that was Aria's question because she could answer.
Oh, Aria,
this
how
one.
should you build wealth for retirement?
She's ignoring us.
But I thought we
were going to talk about retirement income. I mean,
no.
Wide diversification, low cost. Taking more risk when you're young, probably a little less risk when you get closer.
Do you
to
buy
retirement.
a stock? Do you just buy a stock?
A lot of stocks, buy them by the thousands, buy them at a low cost, buy them in a passive or index
Shouldn't I just
type
buy
fund.
Tesla or something?
You could do that. I wouldn't recommend that because, Apple may have a better car in a year and Tesla goes goodbye. I don't know. I'd rather own the whole industry.
There you go.
Yeah.
Or maybe the whole market.
Yeah. By the way, Apple has been terrific this year. I think it's up 20-something%. So, yeah.
It's all my fault. It's all my fault.
I know it is. Oh, speaking of that, everybody's going to ask me on Monday, when do we get our new phones?
I don't know.
Okay.
Probably next week.
Okay.
I don't know. T-Mobile, work on the application I submitted. Come on. They had to send it to underwriting or something.
Good Lord.
Did you write a bad check or something?
I'm just going to give them a credit card.
I know. That's what I can't figure out. They got to approve the credit. You're just going to give them a credit card.
All right, yeah.
So T-Mobile in Bellevue, Washington.
No, so you buy.
We want our phones,
Give me the
darn
phone.
Hey, we're doing our whole company with T-Mobile.
I know.
And we're not even getting anything back for that plug.
That's true.
We never get anything back for any of our plugs. Doesn't that stink?
Yeah.
I do my Chick-fil-A plug.
You do
almost
the
every
Acorns.
Week. Acorns,
Yeah.
Vanguard.
Good point. We got to get somebody to work on this.
That's a good iced tea from Chick-fil-A. Thanks, Chick-fil-A.
To go back to where we were. Yes, wide diversification, low cost, passive or index fund. That will build it. Then you have it. Then what do you do? That's the question. Because that's retirement.
There's the big question.
Yeah.
So when you get to retirement, how do you take an income from it? Is that what you're asking?
I think that's what most people, they want to know. I saved it. How do I pay myself back? That's the big question.
Well, and one of the ways they can do that we mentioned before the break, which was annuitize some of it.
Mm-hmm. You
give it to an insurance company, and you say, I just want you to promise me you're going to pay me back for the rest of my life. And they're going to go invest it somewhere else. And between what they pay you and what they invested in and the fact that they kind of know when you're going to die, Amazing, a time machine they have.
They are smart.
They're going to make money. They
Yep.
plan on making money off your money. So the other option is you could make money off your own money.
Yes.
And derive an income from it.
Yeah.
How do you do that?
Well, there's a number of ways. So you could use the traditional, again, having a widely diversified portfolio, taking money out of that every year. Maybe when you rebalance, certain things went up fast. Last year, stocks made 16, bonds made about 1.5 or 2. So you're going to be selling some of the stocks, rebalancing the portfolio. That would be one way. People want to use dividends. I don't like that as a strategy. You just pay dividend-paying stocks because that's there's a fewer number of companies that pay dividends. It tends to be riskier companies than fixed income. Again, it's kind of hard to make that work over time.
Yeah, the amount you're going to get for a relatively safe fixed income vehicle is really low. So I guess the correct answer is there is no easy, simple, absolute, no doubt about it answer for every person. It's going to be different for everybody. 877-397-5666 is the number. Give us a call.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
Reality radio for a really great future. We're talking real money.
Well, because you need some of it, and you probably are going to need it in retirement, unless you just want to live on Social Security, which I think we've established is not a great idea.
And here's another one. Here's another one that comes up a lot. It came up this week at the 401k enrollments. And this is a big one.
Speed investing.
I
love speed investing dating thing.
Yeah, I really enjoy it. But a lot of people, especially young people, are asking, should I do pre-tax like a regular 401k, or should I put the money, pay the tax, and put it in the Roth 401k? Remember, the pre-tax money, regular 401k, grows tax deferred. Deferred. When you start taking that money out,
you're going to pay taxes.
The government wants their piece at your income tax rate. The Roth 401k grows, and you take it out tax-free, zero taxes.
So you don't get an immediate reduction in your taxes in the year you fund it, but it grows tax-free, and it's withdrawn tax-free, and there's no required minimum distribution at 70.5 either.
You can pass it on, if you didn't spend it, to the next generation, and they could take it out tax-free.
So here's what you have to calculate. What's the value of the deduction to you today? And what would those extra dollars do for you on a taxable basis over the next however long you have to retire?
I can give you one number right now. If your tax rate is 15%, I think it's a no-brainer to do the Roth. Absolute no-brainer.
And here's the other side of this. So this is the thing that if you are and plan to be, if you're young, you plan to be a regular investor, you're just getting started in your career, and you're, as you say, in that 15% bracket, what are the odds you're going to remain in that 15% bracket for the rest of your life? Pretty low.
Yeah, exactly.
Down the road, you'll be in a higher bracket. If you're a regular investor, what are the odds that you're going to have a very valuable portfolio? Well, as we mentioned earlier, if you put $100,000 in the S&P 500 back in 1977 and left it there for 40 years, you'd end up with you would have ended up with $7 million. So if you have $7 million in your 401k when you retire and it all has to come up and have taxes paid on it, ow!
Yeah, it's a lot. That's what we call the required minimum distribution tsunami. Big wave. That's what we call it. Big wave coming at you.
You have a name for everything.
How about that? Yeah, I got one for you, but I'm not able to share it on the air.
You can't say that on the radio either, like the other words. But this is the thing, and this is why I almost always. That's why I almost always default to the Roth option. I think that it's easier to easier to find a reason to default to the Roth than it is to find a reason to default to the tax deduction. The only reason you might want the tax deduction is if you're in a situation where you can't afford to pay the taxes or something.
Well, remember, but if you're a high earner and you're young and your rate's in the 30s, then you could take some of it off today and put some of the post-tax money. I think a balanced approach makes sense.
You've got to hope down the road then, which is a contradictory hope, is that you're in a lower tax bracket in the future than you are today.
When you retire.
When you retire, yeah.
Which you should
and
be.
if you're a good saver, well, not necessarily. See, if you're a good saver,
because
you've got several $1 million in your retirement portfolio, you're going to be in the top tax bracket when you're faced with RMDs.
Yeah,
you're going to be right
125th or something the first year, so it's not a small
that's
number.
A lot of dough.
I recommended, again, 15% bracket, no-brainer, do the Roth 401k. Higher earner, I think it's a split between the two. By the way, the other thing the split does is it gives you more options in retirement. You got different pots of money. This is another thing we talk about in the class. Different pots of type, I've got a taxable account. I have a Roth account. I have a tax-deferred account. Different ways to pull from that money that can be the most advantage. That's the word I'm looking for.
So it gives you good options in retirement.
Yep.
For example, you retire at 65 years old. You can start taking money out of the regular IRA or the regular 401k, pay the taxes on it, reducing that down and keeping that Roth longer at the tax-free growth. 877-397-5666 is our phone number. Those big investing or retirement questions answered for you here on the show every Saturday at 3 p.m. Eastern, noon Pacific. Give us a call.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
your guides to a really great financial future. Tom and Don are talking real money.
If you listen to the podcast, this is going to sound entirely random to you, but it's important. We are talking about retirement. We're talking about investments. Let me just tell you, buying tax liens is not
risk-free.
It's incredibly dangerous. It's incredibly foolish. And the people who sell these programs are making money selling you their DVDs or whatever the heck they have. It's
not easy money?
Ignore.
Not
Put it
easy
on
money
ignore.
for you.
Yeah, put your thing on Do Not Disturb and don't let them call you. 877-397-5666 is our phone number. And Lori, you are up next. Welcome to Talking Real Money.
Hey, Lori, how can we help you today?
Hi, guys. Thanks for taking my call. I am 60 years old, do not have enough money in retirement. I mean, if I retired today, I could live until, I don't know, June.
That's short term, yes.
Yeah. Thank goodness Oregon has assisted suicide. You're all set then. July, you could just go down south. Okay, it was a bad joke. I'm sorry.
I'm wondering at my age, should I bother putting money into a Vanguard account or should I just leave it in my 401k? Right now I'm putting 12% in my 401k. I do have employer matching, but it's kind of pitiful.
But it's something.
So I'm just wondering, it's something,
Yeah.
and I would keep that. I mean, it's like they match 1% and up to the 1% up to my 2%, and then they match
So it's a
another
50%
quarter
match.
of a % up to 3.
Yeah.
Okay. Hey, Lori, I have a question for you.
Yeah.
Since you probably have to, how much longer do you intend to work?
Well, if I'm going to get my full Social Security, I have to work until I'm 70 and 9 months. So I'm going to be working at least another 10 years.
No, it's only 70, by the way.
She
You don't
means
have
that
to
she-
work till then. You could just, if you want to get the max out of
Yeah.
Social Security, you have to wait to draw it till then. But
And you're in good health,
Oh,
right?
okay.
You sound like you're in good health. You
Yeah,
sound
I'm
like
in
a
good
very
health.
young 60-year-old like me. Very young.
Well, you know,
Very young.
there are days when I feel like I'm 80, but there are other days when I feel much younger.
All right, we ignore those days. We just ignore them. They didn't happen.
just said, do not disturb. Turn them off.
So 10 years you've got. So here's what you should do. You should get that at least that 2%, that 1% match, because that's 50% on your money. That's a good deal, even if
Get
your
every
investments
dime
stink.
of that. Get every single ounce. Yep, that's no-brainer.
Then, because, as you said, if you had to retire today, you'd have to go to Oregon in July. You need to, at this point, probably crank it up a little, but probably not in your 401k from the sounds of it. Just first glance, I'm guessing that they're not the best investments. You should.
Over the last 5 years, I think I've averaged about 8%.
Well, that's not
That's
bad.
good,
What,
yeah.
Do you know the company, the mutual
funds?
funds?
I don't have it right here.
Okay.
I could
Anyway.
probably recognize them if you read them all off.
They're only 8,000 mutual funds, so we'll be done by
Program
sometime late tomorrow.
Doesn't run that long. Yeah, sadly.
What the other thing you can do too is go to 401-411.com and see if we have your plan up there or submit it. But what I was going to say is do that because that's tax deferred money. Then do well. You might even because are you in a really high bracket?
Yeah, can I make another suggestion here? Because you're
I'm
wandering
not
all
done.
over the place. Yeah, you're.
No, I know where I'm going.
You're all right.
I know where I'm going.
You know what I think? I think, honestly, I hate to say it, but she needs, not unlike you, some professional advice. Just yours is different.
I need professional help all the time.
No, I mean, I think at 60 and you think retirement looks difficult, I think you should immediately sit down with somebody, a fiduciary, and have somebody look at it. Really.
Yeah, but everybody she
I
needs too
know.
much money.
No, go pay somebody a couple $100 there's planners that would do it for $300. You could go
come to our class.
Yeah, I mean, but honestly, just to give you yes, you should
I
be
know, but
saving.
here's what I was
All
going to
right, go
This is
ahead.
generic stuff. This
Yeah.
is generic stuff. What I'm saying is if you're in a high tax bracket now, do a regular IRA today because that gives you more money to invest. It lowers the amount you're paying to the government, giving you a little more money to invest. If you're in a very low bracket today, then do a Roth IRA in addition to your 401. so that you then spend, as Tom was saying earlier, if you're 8 or 10 years from retirement, yeah, it's worth investing. But if you're really low on funds, you need to work harder at it.
Yeah, that's the best we can do. Go to the class, talk to a professional, keep saving,
and save even more.
Yeah.
Save until it hurts.
Okay, fair enough.
And the lesson for all the rest of us, or you, because I'm 62. The lesson
I'm
for the
not
rest
that far
of you,
away. Sadly.
The lesson for the rest of you listening is don't put it off.
Well, or just go. I don't care what age you are. Start. Do something.
Right. But I'm just saying, if you're in your 20s or 30s and you're going, I'm never going to be as old as those people.
You will. Trust
said.
me.
I survived this long. I don't know how.
Shocking.
And I probably will survive a little bit longer.
All right. Let's go back to the phone, see if we can squeeze in another call.
Okay.
It's
up to you.
Hi, how can we help you?
Hello?
Yes, ma'am.
Hey, great. Husband retired last August. He was 65, so he'll be 66 this August. So he retired. And even though he has his VIP through Boeing, which is, I guess, the 401k, I just heard about this Roth IRA where when you keep it in for a year, maybe I misunderstood, then when you withdraw, you don't have to pay anything to withdraw. I mean, don't you even have to pay your rate of what your taxes are?
No,
or
but
you just pay nothing when you withdraw?
Okay, let's be clear on a couple of things. Number one, the money actually has to stay there for 5 years before you can pull it out.
Okay.
Number two, you have to have income. So you have to have a job.
Security and pension don't count.
Nope.
No.
You have to have earned income.
Then, I got on the ship too long. By the way, when you do withdraw from a Roth, let's say we did for some stupid reason do it, what are we penalized anything more, or do we just pay our tax rate 15%?
When you nothing on the Roth, zero.
Wait, no. She's saying if they put money into a Roth and they take it out before 5 years.
Yeah.
I forget what we'd have to look up what the penalty.
There is an early withdrawal
there's
penalty.
A penalty.
No, it's not just your tax rate.
No, it is. Yes.
Penalty too. Okay.
Yeah.
Well, then, for everybody listening,
No. So hold on one second.
Just
a second. There is one other thing you could do. There is one other thing. You could convert the money that your husband has saved in the VIP into a Roth. Pay the tax on that over the next 3 or 4 years. Then you would have tax-free money to live off the rest of your life. It gets more complicated, but you could take that route.
Well, I'll consider that, and thank you for your time.
You're most welcome.
Thank you. Thanks for calling.
The Roth is a great invention, but it's not some. I guess maybe what people heard is there's a trick that you can avoid taxation. There's no trick to it. You already paid the tax. You already paid the tax when the money's in the Roth. Now, you don't have to pay the tax on the growth of that money. That's a neat little trick, which I hate to say it, but I think one day the great federal government, Uncle Sam, will come along and tell you can't do that anymore because we need the money.
Well, yeah, we don't even have time to get into it, but the latest Trump plan, somebody asked, they said, would this mean that 401ks wouldn't be deductible anymore? And 3 different people said 3 different things.
No, I didn't know.
I don't know.
Other things?
We didn't think about that part. We'll tell you later. We'll let you know.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
Hi. We don't have much time left, so I want to remind you about the class. We've got classes coming up, brand new classes. In fact, I'm not even done creating them yet. I'm still fine-tuning them. And they're we're going to hold these classes on retirement investing and retirement income, the science thereof, in Tukwila, Linwood, and Bellevue. And tickets will be $15 at the door, but you can get presale tickets for only $10 at TalkingRealMoney.com, TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.